Excellencies, dear governors of the African Development Bank Group, ladies and gentlemen, it's really a great pleasure for me and my team to be presenting to you today the African Economic Outlook Report for the year 2022. As already gathered in this conference, climate change is an existential threat for Africa. Africa has contributed little to the global climate emissions, and Africa is suffering the most from climate change. So finding policies that can triangulate addressing climate impacts, which is real for Africa, and also allowing Africa to continue to grow within that carbon headroom that the President has introduced, was the subject of inquiry of this report. If we do that, we'll be able to achieve what we've called inclusive growth. The report is structured in 3 chapters. The first is on Africa's economic performance and outlook. The President has already painted the picture for 2020, 2021 and 2022. Then we looked at climate resilience and just energy transitions in Africa. The innovation here is that we have always been talking about climate resilience and meeting the global climate commitments. But we also know that the Sustainable Development Goals has as a key goal universal access to energy. And that is for a reason, because energy access is fundamental to achieving all the other goals that we have in the global goals for 2030. Financing climate resilience and just energy transitions becomes then very important for continents and countries suffering most from climate change, such as Africa. So this report is supposed to bring all this together and see where we can find the innovations and practices to be able to achieve that inclusive growth, triangulating the need to grow our economies, the need to be climate resilient, reduce emissions and adapt to climate change, and also the need to be able to find the financing required to reduce the impacts of climate on society. So I've already painted 3 pillars of sustainable development, which is old, since 2002 in the Broadland Report: the social, the economic, and the environmental. If we're able to do this in Africa, we will be a leader in terms of how to build the new inclusive growth paradigms that is being looked at. Chapter 1. In this picture, you see the growth deceleration to minus 1.6% that the President talked about in 2020, and the rapid regrowth that the rebound in Africa's growth to 6.9%. But shortly after, we have global tensions and other policy stance globally that is impacting the continent, and then we're projecting that in 2022 is going to decelerate to 4.1%. And 2023, that deceleration will continue. But if you look at that picture as well, you'll find that Africa, compared to other regions, didn't fare badly in terms of how we have responded to the COVID-19 pandemic. So I would like to give it up to our finance ministers, our heads of states, and our leaders for the rapid response policies that helped us to be able to bolster this shock, and also our global partners that came together and rallied with us to support. Now here is trying to look at the regional differentiations in this growth that we are seeing. North Africa had the highest rebound, recording a growth of up to 11.7% in 2021. But again, that deceleration to about 4.5% in 2022 because of the global challenges that we have been talking about here. West Africa, East Africa, and Central Africa have all gone back to positive growth after deceleration. To point out there, Eastern Africa did not have a contraction in 2020 because of several policies that they implemented, which you will find in the report. Because of what of time, I'm not going to delve into all those. And then Southern Africa, that was the hardest hit by this pandemic, that saw a contraction of 6%, is handsomely growing at 4.2% in 2020. but there's also projected to be a deceleration because of the issues that we have been talking about. Now, if you look at the economic characteristics of countries, whether they are oil exporters or resource-intensive, non-resource-intensive, tourism-dependent, we also see different patterns in terms of how this recovery has happened. With the tourism-dependent economies having the greatest rebound in its growth rate. But the oil-dependent economies, the oil-exporting economies also did very well. So you find in the report the details of the key drivers of these growth changes that we are painting here. So I'm not going to go into depth because of time. Now, generally, we see that the macroeconomic fundamentals in many African countries has improved. But challenges still remain. The first of those challenges, the most pressing now, is the debt issue. And the president has already painted the picture for us that we see that we see that tapering in the level of the growth, but of growth in our debt vulnerability and debt ratios as a ratio of our GDP. But we are predicting that it will stabilize still above 70%, above pre-pandemic levels. And the reasons for this are many. Domestic policies that needs to be implemented, public financial management that needs to be improved, but also exogenous shocks that are there that often impact Africa's economies. So this is an issue that we need to look at continuously. But again, we see consumer price inflation coming back into the picture, rising up to like 13.5% in 2020. So these are some of the two main challenges that African countries, from our perspectives as authors of this report, should focus on in the near term. Now, in terms of financing economic recovery, the president has already mentioned to us that Africa will need about $432 billion US between 2020 and 2022 to respond to the COVID-19 pandemic impacts only. But we will see there are other financing needs that Africa also has. And Africa also needs more than a decade to recover from the COVID-19 impact. And if you look at the impacts of COVID-19, we were still doing this analysis when the Russia-Ukraine war broke. And currently, we see that in addition to that 30 million Africans that was pushed into extreme poverty because of COVID-19, up to 2 million will also slide into poverty in 2020, 2022, 2023 because of the Russia-Ukraine war already. If that war persists, the impacts will even be higher. Now, the next thing in the report, this seems not to be working. Okay, so these are just the figures about those who went into extreme poverty. So that's the painting of Africa's economic outlook, 2020 to 2023. But then we go into climate resilience and the just energy transitions. We looked at climate vulnerability, readiness, and resilience indicators across African economies and across the global economies, not just Africa, in order to put Africa in the map. And we find that Africa was the second least climate, had the least climate vulnerability index. So in all countries, it's only South Asia that is more vulnerable to climate change than Africa was. And we showed the least climate readiness. If you look at other indicators, because of that combination of those factors, Africa is the least climate resilient region of the world. And then we try to look at different countries to see what are the things that's driving this climate vulnerability and climate readiness. And we find, you see, most of the countries here are not African countries. And they were more, Northern and Southern African countries were more climate ready and climate resilient. And if you look at the structure of their economy, it's also a little bit different. So that leads us to some initial conclusion that climate resilience and climate vulnerability is somehow linked to economic structures. So if you read the report, you'll find a little bit details. One interesting thing in the report is that these countries also were the ones that mobilized climate finance. So again, when you are less climate vulnerable, you have higher opportunity of getting climate finance, which is some form of misalignment of resources. So we'll come back to that as we go forward. Here is just the socioeconomic impacts of climate change, which for me is the raison d'etre for African governments to take climate change really seriously. Between 1986 and 2015, Africa lost 5 to 15% of GDP per capita growth due to climate change. And this is in addition to the loss of lives, the climate-induced insecurity, and conflicts, and all those things that happen across the continent. But other social consequences are also there. We try to look at why is this happening, and you'll find, again, economic structures is part of it, institutional capacity is part of it, and there are several factors that are drivers of these impacts, where the impacts are higher than in other countries. That we can look at going forward. Then this brings us to thinking of climate justice, because already in this picture I'm painting, you can see that the flow of climate finance doesn't seem to be going to the more vulnerable. So the more vulnerable you are to climate change, the less likely you are even to get the financing that is being made available for countries to address this climate change. But another important thing is that the major driver of climate change is the energy systems of countries. But we also know that SDG 7 is about universal access to energy for the reasons that we have talked about. So there are some trade-offs that we need to think about here. We need access to energy, but we also need to mitigate climate, because Africa is suffering more, and because of its high vulnerability, is a major policy stance for Africa to address climate change. So if you look at this picture here, there is no gainsaying the fact that GDP growth and access to energy is highly correlated. So if you reduce access to energy, you are just simply reducing socioeconomic development of the country. So we have to keep this in mind when we are talking about energy transitions, which one is just and which one is not just. And here, we then try to look into history. How is the energy mix of countries? How has it been for the different regions? So we looked at Africa, China, European Union, India, and United States. The gray part of here is coal. And you can see that Africa has reduced coal in its emission significantly, from about 56% to about 29% of its mix between 1985 and 2020. And the other regions that have similar transitions are European Union and the United States of America. For the other regions, you see how high coal is and remains in their energy mix. But another thing we see there is that transitions take time. It's not something that happens quickly. So that time it takes, and these countries, the regions that have managed, used gas as a transition fuel. So gas is a central aspect of being able to decouple from coal. And this is why you continue to see this call by the African Development Bank that gas must remain part of the energy mix of the continent, while not compromising the Paris Climate Agreement. Another point to see here is that renewable energy has increased, but has not increased really significantly. That's the green line on top there. The highest growth is in European Union, where it has reached up to 29% of the energy mix. So while renewable remain an important part of the energy mix, it's still not yet there in terms of technological efficiency and capacity to replace everything in the energy mix. So we looked at Africa's energy mix vis-a-vis other regions, and we'll find that Africa's energy mix is actually less carbon intensive than most of the other regions as well. So here we look at the carbon emissions. This is what the president was talking about in terms of looking at the carbon budget of the world, how much of it is still available, how much has been spent, and what is remaining, and how can we have an equitable allocation of this carbon budget that remains in order to meet net zero transitions and have some kind of equity in terms of historical emissions, current emissions, and future emissions, and the need to grow economies. So from that analysis, of course, we know that emissions from Africa is very little, less than about 3% of the historical emissions. Here is then the calculation of the carbon, what we call the carbon credits and carbon debts of different regions of the world using the current social cost of. But if you think about your country and the huge renewable energy opportunity, this is an opportunity for you to grow your economy in the new normal, because our analysis also show that technology shifts, policy shifts, and market shifts mean that continued investment in fossil fuel energy systems is simply risking, has what we've called asset stranding risks. So we need to be able to move with the times. Chapter 3, financing this climate resilience and just energy transitions. We find that the current climate financing architecture mirrors the global financing architecture. And because of that, the structure is very complicated and loosely defined. Almost everything can be branded climate finance. In Africa, we have about 2/3 of the climate finance flows that came into the continent in the past decades were actually debt. And 33% of that was non-concessional debt. So this raises questions about how do we, it's giving debt, accumulating debt for countries that are more vulnerable to climate change, poorer, and that is deepening the debt sustainability challenges in these countries, increasing social fragility, economic fragility, and we also know that these things lead to environmental degradation. So it's a vicious cycle. Flow of climate finance, we've already talked about it. It's misaligned with climate vulnerability and risks. And this is just a picture that will show you that. Being more prone to climate impacts doesn't mean that you get more climate finance because of several issues, institutional capacity, several things. I'm not going to go into it. Read the report and we can find it. Now, more importantly, it's also misaligned with the scale of climate finance that is required for Africa to be able to reach net zero. Remember that in the Paris Climate Agreement, there were conditional nationally determined contributions and non-conditional nationally determined contributions. Those conditional nationally determined contributions was dependent on global climate finance coming into this continent. And what we have estimated is that to implement that NDCs of Africa requires up to 1.6 trillion, not billion, 1.6 trillion US dollars between 2020 and 2030. But Africa has only received annually 18.3 billion in the past decade for that period shown there, 2016 to 2019. So this leaves us with up to 127 billion US dollars in climate finance gap annually. If you look at the average, it comes to like 108 billion per year. So in current trends, the risk of not being able to implement the NDCs in Africa is real. And the implications for global sustainability and meeting net zero, I will leave us to think about it as we go forward. Policy recommendations. One key area is policy coordination, ensuring that fiscal policy and monetary policy work together to build economies, achieve resilience, and also protect the vulnerable. The second one is building and strengthening regional value chains. For reasons I don't think I need to explain after COVID-19, we all see why it is necessary. The scale of investments in renewable energy is still low, not only in Africa, but across the world. We need to scale up massively if we have to change that trajectory in the energy mix that we showed you. So investing in institutional capacity development for green transitions, technologies, markets, commodities, and so on is very important so that Africa doesn't remain an exporter of raw materials for this new development paradigm we are seeing, just as we have been doing before. Because if you operate at that low level of your value chain, you will get low level of resources flowing into your economy. There are no two ways about that. So we need to engage in terms of building capacity to be able to produce technologies at home and use these technologies so that we can move forward. Some other work we've done with the International Resources Panel show that the carbon footprint of some of the technologies we call renewable are not really renewable, because the raw materials go from Africa to a different region, it's produced there and it's shipped back, and guess what? It's running on gas. Not gas, actually, it's diesel. So when you build all these things in terms of the carbon that was included in terms of the production, the exportation of raw materials, the re-importation of it, for Africa, the carbon footprint of even solar panels may not really be very sustainable. So we need to think about that by localizing the industries, building the industries here, and ensuring that we benefit from that. So this leaves us with a very clear imperative for the international community. Honoring the 100 billion. If you look at what is owed and what is promised and what the flow is now, it tells its own story. The next one is expanding innovation to deepen financing instruments. We have green bonds, sustainability-linked bonds. There are several financial innovations that can be done by countries and by multilateral development banks so that we can help Africa to be able to come out of this quagmire. Increasing concessional financing to support climate adaptation and just energy transition is key, because climate finance, as currently structured, does not flow to the vulnerable countries. So and this is why, like a higher ADF replenishment and allowing ADF to go to market is imperative for Africa to adapt to climate change. Because if we depend on climate finance, it doesn't go to those who really need it most. For reasons that is very clear. Conclusions. Climate change is a global commons problem and requires collaborative action and global action to address. A global commons problem means that if I do my part and you did not do your part, all the things I have done doesn't really mean much. So we cannot push Africa to address climate change if all of us is not addressing climate change. And Europe addressing climate change will not lead far if Africa is not addressing climate change. So we all have to make sure that as a global community, we protect our common futures together. The reason is simple. Greenhouse gas emissions does not know boundaries. It accumulates in the atmosphere freely and creates impacts freely as well. So we need to make sure that that's done. Energy systems needs to be technologically adequate, cost optimal, and viable. And viability is not to meet the Paris Agreement only, but to meet that in addition to achieving universal access and driving all the other SDGs and Africa's Agenda 2063. We need decentralized renewable energy systems. This is key for rapid access to energy and to electricity, especially for countries that are still in the dark. I mean, continents where in Africa we have 600 million people still in the dark. So fast-tracking decentralized renewable energy is just obvious for us in Africa, given our resource potential. Doing that will also increase our share of the emerging global green economy. So we need to do that fast so that we are not latecomers in that as well. Significant financing, we have talked about it already. We have only looked at two aspects of financing here. COVID-19, which is a short-term issue. So we looked at just 2020-2022, 432 billion required. And then to address the NDCs, which we have already agreed to as per the Paris Agreement, requires up to 1.6 trillion US dollars. Dear deputies, excellencies, ladies and gentlemen, it's my honor to thank you for listening to this presentation and to ask us to go home with just one question. What part do I need to play to ensure that we avert climate catastrophe for the world? Thank you.